Good morning, ladies and gentlemen. For most of us, investing is a way to grow our wealth and ensure we have as much money in the bank as possible so we can look after ourselves and our family and have freedom of how we want to live our life. So if that is the end goal, then surely becoming the richest person in the world means you would have won. Well, today we're going to be taking a look at the company that made Elon Musk the richest person on the entire planet and whether it could do the same for you. Or is the stock too overvalued and too volatile to add to your portfolio? Today, we're going to be breaking down Tesla. I'm going to show you the profits or losses I've made on it in the past and how you can buy it in South Africa if you want to. So let's lift off. No, wait, that was bad. Anyway. Okay, where to start on this one? The story of Tesla is both legendary and complicated, but there is one place for me that sums it all up pretty nicely, and it's just a simple blog post from Elon Musk himself on the Tesla website from 2006. It is titled The Secret Tesla Motors Master Plan, and 16 years ago he detailed his plan for the budding company. In it, he describes the idea behind a more environmentally friendly electric car, the power and consumption of batteries compared to gasoline, and right at the bottom he outlines the master plan. Build a sports car. Use that money to build an affordable car. Use that money to build an even more affordable car. While doing above, also provide zero-emission electric power generation options. Don't tell anyone. So apart from the last one, most of those Tesla has done. Today the company sells a range of 4 models of electric cars as well as solar power and battery related products, and it's no secret that as the years have gone by their share price has been very successful, going from $3 at listing all the way up to $1,222 at its peak, for a growth of 26,851% over 12 years. We were even able to make some money when we sold our previous shareholding for a 25% profit last month, which we'll get into later. So I guess the big questions we have to ask ourselves as investors are two things. The first being, is it worth it? Does the share price really justify the actual value of the company? And secondly, whether it does or doesn't, can we make money from it? Now, Tesla does not pay dividends yet, so it's all about the capital growth here, all about whether the share price will rise or fall. And with this company, there are many factors that affect that. There is the popularity of its founder, Elon Musk, South African from Pretoria, done good, who can send a dumb tweet and wipe out billions of dollars in value. Then there's the $1.5 billion in Bitcoin the company purchased last year, which affects their value based on the crypto markets. And lastly, there are all the business, economic, and logistic factors that affect any business, like the availability worldwide of semiconductors, how fast their factories can meet demand, government subsidies for electric vehicles, and the performance of the Chinese market. Now, as you know, shares don't always trade on their actual value. They often trade at a future value, which means people factor in if they think a company will do well. Then if there is more demand for it, the price goes up. The same way someone might put up the price for an umbrella if they know it's going to rain later. So many people think that electric energy and cars are the way of the future and that Tesla will have a very big chunk of that market. So they pay a premium for the shares because they think in the future they will be worth a lot. But how do we know just how overpriced the share might be? Well, for the most part, we take a look at the PE ratio, or the price to earnings ratio. This allows us to compare companies with apples for apples based on its share price compared to how much the company earns per share. The higher that number is, the more expensive the share is for how much the company makes. So Tesla has a price to earnings ratio of 207. Now, for comparison, get this, General Motors is 6.59 and Ford has a PE ratio of 3.78. So on top of that, according to share price, General Motors market cap is $64 billion. Ford is $67 billion. Toyota is $284 billion. Together, they sold 23 million cars in 2019, but Tesla's market cap is $1 trillion and only sold 367,000 cars that year. So those numbers show you just how expensive and frankly overinflated Tesla shares are. So that answers our first question. Is it worth it? The answer is no. For now, at least, the share price does not justify the company's earnings. So on to the second question, can we still make money from it? Let me take you back to May last year when we bought 2,000 Rand of Tesla shares in an ETN. It was after the share price had dropped by 26% and I thought it was a good entry point. Those shares went all the way up to over 100% profit and back down again until we sold at a decent return of 25% over 9 months. So is it possible to make money? The answer to the second question is yes. But keep in mind, this type of investing is called speculating. Basically betting on whether a price will go up rather than value investing, which is based on strong company fundamentals. All right, well, let's take a look at Tesla today and what we think of the price. The main thing that caught my eye was that once again there was a dip. In this case, it was down 37% from its highest point in November. Now, when I bought on the 20th of May last year, it proceeded to go up 117% at its highest. My thoughts was that a bigger dip coming off a higher high point could make for some good growth as macro conditions improved. I decided it was another good entry point and time to go in for 3,000 Rand, or in this case around $200. I converted my rands to dollars and invested $192.79 on the 10th of May. Since then, we have in fact seen some growth, and the share price is currently up by 21% in 13 days, which is a profit of $40 or 618 Rands. So I'm going to hold on to it and we'll see where the price goes in the years to come. Now, I always say that we share our buys and share our sells, profits and losses, but I'll also say again that this is an overvalued stock and we're just speculating on price, which is riskier, but it does fall within the 5% we've allocated in our portfolio for riskier investments. So if you're considering it, make sure it's right for your portfolio risk. Now, that was a lot of numbers, but I guess that's what we're here for, right? So that is it for today's episode, guys. I hope you enjoyed the information, and if you'd like seeing these insights into our decisions, and if you want more videos like this on companies and investments, please feel free to subscribe to the channel and like this video. We've got some exciting stuff coming up, so I hope to see you then. But until then, I'll see you guys next time on Casual Cash. Cheers.